Welcome back to Bull Bear Brains. Today, we're diving into the fascinating world of stock valuation. Ever wondered how to determine the true worth of a stock? Let's start by understanding the concept of intrinsic value. This is the real underlying value of a stock, considering future cash flows. It's not always reflected in the current market price, but it's a critical number for savvy investors. It's like the North Star guiding us through the stock market jungle. To get to this magic number, we have to think about the company's future earnings. Let's say we have a company that consistently earns $1 per share each year. We expect this to continue for the next 10 years. Now we apply a discount rate, let's say 10%, to determine the present value of these future earnings. This calculation gives us the intrinsic value, the so-called real value of the stock. So, intrinsic value, in essence, is akin to finding the hidden treasure in the stock market jungle. Moving on, let's decipher the price-to-earnings PE ratio, a fundamental metric for investors. The PE ratio is like the price tag on a stock. It tells us how much investors are willing to pay for each dollar of a company's earnings. The higher the PE ratio, the more the market is willing to pay for each dollar of earnings. Let's break it down with an example. Suppose a company's stock is trading at $50 per share and it has earnings of $5 per share. To find the PE ratio, we divide the price of the stock by its earnings per share. So, 50 divided by 5 gives us a PE ratio of 10. This means that investors are willing to pay 10 times the earnings of the company for a single share. The PE ratio thus provides a gauge of the market's expectation from a stock. Next on our list is return on equity, or ROE, a key indicator of a company's profitability and efficiency. ROE is a performance ratio that measures the ability of a firm to generate profits from its shareholders' equity. Essentially, is the profit a company makes for each dollar it has in equity. Now, how do we calculate ROE? It's quite simple. We divide the company's net income by its shareholders' equity. Let's consider a hypothetical example. Suppose a company has a net income of $5 million and it has $20 million in shareholders' equity. When we divide the net income by the shareholders' equity, we get an ROE of 25%. What does this mean? Well, a high ROE, like our 25%, indicates a company's adeptness at turning equity into profit. It's a clear sign that the company is efficiently using the invested money to generate earnings growth. And that's why ROE is such an essential tool for investors. Lastly, let's delve into the debt-to-equity ratio, a metric that uncovers a company's financial leverage. This ratio provides insight into how a company is financing its operations and growth. It compares the total debt, which includes both short-term and long-term liabilities, to the total shareholders' equity. Think of it like this. If a company has $30 million in debt and $70 million in equity, we calculate the debt-to-equity ratio by dividing the total debt by the total equity. So, 30 million divided by 70 million gives us a debt-to-equity ratio of 0.43. What does this mean? It indicates that for every dollar of equity, the company has 43 cents in debt. A lower ratio could suggest a more financially stable company, while a higher ratio might indicate more risk. The debt-to-equity ratio, hence, reveals the balance between debt and equity in a company's financing. There you have it, folks. We've covered the essentials of stock valuation, from intrinsic value to PE ratio, ROE, and debt-to-equity ratio. Remember, these metrics provide valuable insights into a company's financial health. If you enjoyed this video, don't forget to like and subscribe. Until next time, happy investing!